When you are choosing your 401k investments, safe and reliable come to mind, right? Well, before you make your next move, you may want to listen to our next guest.
He has 3 funds that could be killing. Yes, killing your 401k. Jeff Reeves is editor of InvestorPlace.com. All right, Jeff, let's start with the auto sector, because last week there was some good news towards the end of the week with for GM particularly, looked like the golden child. Everybody was talking about how they've turned the corner, et cetera. But you say bad times may be ahead for auto sectors, and particularly for Fidelity Select Automotive. Explain.
Yeah, and to be clear, all these funds that we're talking about here, there's 3 specific ones, but generally for most 401k investors, I think there's lessons to be learned from all of these. So just because you don't own these 3 doesn't mean the Grim Reaper isn't cooking up an omelet with your 401k.
Right.
So the Fidelity Select Auto one I don't like. Number one, Select Auto or Select Sector funds in general, a pretty bad idea for a lot of investors who are long-term. A sector bet can be kind of a swing trade, short-term. In the short term for 2012, I think auto is kind of hitting a rough spot. Like you said, GM had really good earnings, but if you look at the details, they didn't turn a profit at all in their European operations. They didn't turn a profit in Latin America. All their growth came from North America, and as you and I both know, it's not like that growth is going to last forever. It was just basically a rebound from the bottom.
But Jeff,
there's also a lot of concern about China right now, too, and automakers are betting big on China. So
okay,
auto
but this wouldn't have killed your 401k had you had it in 2009 when it was up 122%, and then spin it forward to 2010, up 46%. But you're saying now shed it if it's in your portfolio for your 401k.
Yeah, exactly. I mean, these sector plays, again, a 401k investor, if you're looking towards retirement, you're looking towards long term, it's vastly different than a swing trader. If you're looking to, say, play the rise in tech or financials, that's vastly different than kind of a long-term retirement investing.
All right, your next one is Vanguard Diverse Equity Fund. I would look at Vanguard Diversified and say, don't you want a diversified equity fund?
Yeah, on the surface, it sounds like it's a great name. I mean, why wouldn't everybody want to own it? But the problem is that it's a fund of funds investment, meaning it's a mutual fund comprised of other mutual funds. So you're going to pay a decent amount of expenses there because all the managers got to eat. And generally, people shouldn't buy funds of funds, in my opinion, because it kind of dilutes the strategy. You have too many cooks in the kitchen. This particular fund has 20 different managers for about a half dozen different funds. And actually, if you look at the details, all their top holdings, they share a lot of the same positions. They got Pfizer, they got Apple. So you have to wonder, why are you paying the extra expense of all of these funds when you can just find one and get that same kind of pop for your 401k? I mean, generally, I don't like the fund of funds model, but this Vanguard one is particularly galling because I think 20 managers is just way too many.
Look at this.
You're paying for layer on layer of management, too, as you go. So in the end, it's not a good deal.
They all got to have secretaries. They all want to have nice cars, and you shouldn't be paying for that.
All right, gold. Let's talk Oppenheimer gold. You say there are better ways to hedge against inflation. Of course, gold is the classic inflation play. But what if I don't like gold as an inflation hedge, what else could I use?
Well, here's the thing, is that, again, when you think about your 401k, you think about retirement investing, it is longer term, and gold is a very volatile investment. You know, people shouldn't buy into the hype about all these pawn shops that are going after gold and the commercials on TV. Gold kind of waxes and wanes, and the last gold bubble in the 1980s, it flopped 65% in just a couple years, and we're kind of just getting back to square. So if you figure you're a long-term investor, you don't want to play the volatility too much in your 401k. I believe there are inflation hedges, but that's why if you have a good diversified portfolio with some value investments, maybe some oil stocks, there's ways to play the inflationary environment until it kind of passes out and then your manager rotates you in or the index fund kind of takes you back to square. So I believe there's ways to play inflation in the long term that are a little bit safer for your portfolio than gold because it is a very volatile investment. I think a lot of 401k investors don't understand that with all the hype right now. The returns are there, but it can swing the other way, too.
Well, Jeff, this is just a great segment because it just shows that one dumb decision can actually kill whatever gains, meager gains, depending on the year that you get in your 401k. How do you spot a problem child fund?
Well, I mean, you got to be very careful not to look at the short term because the gold is a perfect example. I mean, last year gold lost something like 30% for most gold funds. I mean, the one that I pointed out, it's not alone. It also has a very high expense ratio of about 2%. So if your expense ratio is too high, very, very high. I mean, I'm kind of the mind that, I mean, we all know that a lot of managers don't even beat their bogey. They don't beat the benchmark that they're indexed to. So why would you not just go for a lower cost fund that doesn't cost you as much money that basically gets the same performance? I think expense ratio is very important to look at. If it's over 1%, you definitely have a lot of warning bells there. And you have to look at the long-term performance, the tenure of the manager. If the manager's only been there for a year or two, or if you have a big pop of, say, 20% in a single year, I mean, that's all nice. But gold had a big pop, and then gold fell off. auto had a good run and then it fell off. The thing is about 401k and retirement investing, you're looking for years, not months. And if you want to have a long-term growth in your retirement nest egg, you don't want that Grim Reaper coming after you. You got to make sure you look at the big picture, long tenure for your manager. And I think at least a 5-year return or more has to be a beating the market magnitude in order for a fund to be attractive.
Look, if you don't have this guy's phone number, if you don't have Jeff's private phone number, you can always go to investorplace.com because, Jeff, I would like to call you next time I'm going to move my assets in my 401k.
Hey, email me.
I know I can, and I know it's not fair, so I'm just going to go to investorplace.com, which is how you all can take advantage of Jeff Reeves. Jeff, thank you very much.
Happy Washington's birthday, everybody.
That's right.
And Lincoln, don't forget Lincoln.
Very valuable information from Jeff Reeves of investorplace.com.